Life is unpredictable. Unexpected expenses like medical bills, car repairs, or job loss can hit when you least expect them. That's why having an emergency fund is essential. It's your financial safety net, giving you peace of mind and protecting you from going into debt when surprises happen. In this discussion, we'll break down why an emergency fund matters, how much you should save, and how to start building one today. Today, we will talk about the importance of an emergency fund. So before we start, make sure to hit the like button and subscribe to my channel. The concept of an emergency fund. An emergency fund is a financial safety net designed to cover unexpected expenses or financial emergencies. It acts as a buffer that prevents you from dipping into savings meant for other goals, using credit cards, or taking out high-interest loans. Typically, an emergency fund should cover 3 to 6 months of living expenses, though the exact amount can vary based on personal circumstances such as job stability, number of dependents, and existing debts. This fund is not meant for routine spending or planned purchases, but rather for unforeseen events like medical emergencies, job loss, car repairs, or home maintenance issues. Building an emergency fund is the foundation of a sound financial plan because it provides peace of mind and financial resilience. Without it, even minor disruptions can create major setbacks. Understanding its purpose helps you prioritize savings and make informed decisions about budgeting and spending habits over time. 2. Why you absolutely need one. Many people overlook the necessity of an emergency fund, assuming that stable income or insurance is enough to safeguard them. However, life is unpredictable. Job loss, sudden illness, or a global crisis, such as the COVID-19 pandemic, can affect even the most prepared individuals. When such disruptions occur, having an emergency fund can be the difference between staying afloat and drowning in debt. Without it, you're forced to rely on credit cards, personal loans, or borrowing from friends and family, which can create additional financial burdens. Additionally, insurance doesn't always cover everything. Deductibles and uncovered expenses can still set you back. An emergency fund allows you to navigate these tough situations with confidence and dignity without derailing your long-term goals. Think of it as your own personal insurance policy, fully under your control. It's not a luxury, it's a necessity for everyone, regardless of income or lifestyle. 3. How much should you save? The amount you should save in an emergency fund depends on your lifestyle, job security, monthly expenses, and risk tolerance. The general rule of thumb is to save at least 3 to 6 months' worth of essential expenses. This includes rent or mortgage, utilities, groceries, transportation, insurance, and any minimum debt payments. If you're self-employed, have irregular income, or support dependents, consider saving up to 9 months' worth. Start by calculating your monthly essentials, then set a realistic savings goal. For example, if your monthly expenses are $2,000, aim for a fund of $6,000, $12,000. While this may sound daunting, remember that saving a little consistently is better than not saving at all. Set small milestones, $500, $1,000, and so on. Every bit helps. The key is consistency and commitment. The sooner you start, the sooner you'll feel secure, knowing you can weather unexpected storms without panic. 4. Where to keep your emergency fund. Choosing the right place to store your emergency fund is just as important as saving it. It needs to be easily accessible, but not so easy that you're tempted to dip into it for non-emergencies. A high-yield savings account is often the best option, offering better interest than a traditional savings account while maintaining liquidity. Money market accounts and certificates of deposit, CDs, are other options, but be cautious. CDs may have withdrawal penalties. Avoid keeping your emergency fund in investment accounts like stocks or mutual funds, as market volatility can decrease your fund's value right when you need it most. Cash at home is another risk due to theft or disaster. The ideal emergency fund location balances safety, liquidity, and some return on your money. Also, keep it in a separate account from your everyday spending to avoid accidental use. Out of sight, but not out of reach. 5. How to build it from scratch. Starting an emergency fund from scratch might seem challenging, especially if money is already tight. However, with determination and small steps, anyone can build one. Begin by analyzing your current expenses and identifying areas where you can cut back. Subscriptions, eating out, impulse shopping, etc. Redirect those savings into your emergency fund. Automate contributions to make saving habitual. Even $10 or $20 a week adds up over time. Use windfalls like tax refunds, bonuses, or gifts to boost your savings. Consider using budgeting methods like the 50-30-20 rule, where 20% of your income goes towards savings and debt repayment. You can also pick up a side gig temporarily to accelerate your fund's growth. The goal is not perfection, but progress. Remember, the sooner you start, the quicker you'll build a cushion that can protect you when life throws you the unexpected. Stay patient and stay consistent. 6. When to use your emergency fund. The emergency fund is not for sales, vacations, or the latest tech gadget. It's strictly for unexpected and necessary expenses. These include losing your job, urgent medical bills, emergency car or home repairs, or unforeseen travel due to family emergencies. It's important to define your own rules on when and how the fund can be accessed to avoid unnecessary withdrawals. If you're unsure whether an expense qualifies, ask, was this event truly unplanned? Is it essential? If the answer is yes, then the fund is serving its purpose. After you've used the emergency fund, prioritize replenishing it before other non-essential expenses. It's there to absorb the shock of life's surprises, not to fund lifestyle choices. Learning discipline in how and when to use your emergency savings is just as important as building the fund itself. Use it wisely, and it can be a lifesaver, literally and financially. 7. The psychological benefits of having a fund. Beyond financial protection, having an emergency fund offers tremendous psychological relief. Money-related stress is one of the leading causes of anxiety, depression, and relationship issues. Knowing that you have a cushion to fall back on in case of emergencies gives you peace of mind and reduces the mental load of daily worries. It allows you to make decisions from a place of confidence rather than fear. You sleep better, plan better, and handle problems with more clarity. Financial emergencies don't just affect your wallet, they affect your mental health, your ability to perform at work, and your relationships. A well-funded emergency account becomes a source of emotional stability. It fosters a sense of control over your financial life and instills the confidence that you can handle whatever life throws your way. This psychological strength is invaluable, especially in a world filled with uncertainty and rapid change. 8. Common mistakes to avoid. Even with the best intentions, many people make mistakes when it comes to emergency funds. One common error is treating it like a general savings account and using it for vacations or planned expenses. Another is underfunding the account, saving only $500 when your real needs might be $5,000. Some keep it in hard-to-reach places like long-term investments, where access is restricted or values fluctuate. Others rely too heavily on credit cards, thinking they can serve as a backup. But credit cards are not emergency funds. They create debt, not security. Also, neglecting to replenish the fund after using it defeats its purpose. Finally, many people simply delay starting, thinking they'll get to it later. The truth is, emergencies don't wait for perfect timing. Avoid these pitfalls by treating your emergency fund as sacred, strictly for emergencies, adequately sized, and always ready. 9. Long-term financial benefits. In the long run, an emergency fund does more than protect you during crises. It empowers your entire financial journey. With a strong emergency fund in place, you can invest more confidently, knowing that you won't need to liquidate assets in case of a crisis. It also allows you to take calculated risks, like changing careers, starting a business, or pursuing further education, without being financially paralyzed. Your credit score benefits too, since you won't rely on debt to handle unexpected costs. You'll avoid high-interest loans, late fees, and potential bankruptcy. Most importantly, it helps you stay on track with your financial goals, whether that's buying a house, saving for retirement, or funding your child's education. In essence, a good emergency fund acts as the base of a strong financial pyramid. The stability it provides frees you to build wealth, pursue dreams, and live life with greater freedom and fewer worries. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.